Hello, Andrew here. Welcome to my channel on investing. Why beating S&P 500 is so hard? This question comes down to the tug of war between active and passive investing. In this video, I will take a look at different reasons why active fund managers lag behind S&P 500. I also conclude why broad stock market index ETFs, such as VOO, are the best way to go for small investors. The first and most important reason is how S&P 500 committee selects stocks. The committee weeds out stocks based on profitability, market cap, and liquidity. Thus, if a stock starts to underperform, the committee drops it out of the index. This approach, in essence, favors relative performance by amplifying strong returns and suppressing weak returns. Since 2015, nearly 180 stocks were booted out from the index and replaced with something else. But this is unsurprising given a fast-changing pace of the US economy. For instance, Uber and Airbnb joined the index in 2023. At the same time, Lincoln National and Newell Brands were booted out from the index, which are two companies in insurance and household products. And again, this is not surprising given that the role of technology is growing these days. So look at S&P 500 and investing in it as the taking advantage of collective wisdom and proxy view on the performance of the US economy. Moreover, the S&P 500 does this reconstitution in a systematic and periodic way. It's quite simple actually, and maybe even mechanic in a way, but this simplicity is what makes all the difference. Conversely, it's very hard picking stocks, and to some extent it's even harder to decide when to sell them. S&P 500 achieves these goals in a predefined way that doesn't require too much thinking. And as Charlie Munger said, the big money is not in the buying and selling, but in the waiting. The second reason has to do with finding winners. After all, this is what all fund managers are after, to find alpha. But finding winners is very difficult. Take Magnificent 7 stocks, for instance. They appreciated by an average of over 100% in 2023. In comparison, S&P 500 total return was roughly 26% in 2023. Without Magnificent 7, the S&P 500 total returns would have been much lower, probably in the realm of 12% or even much worse. Even if you zoom out in time, the Pareto law that says that 20% of things we do produce 80% of the results holds true. For instance, Morningstar calculated that S&P 500 total returns were 12.9% from 2013 to 2022. What's more, these returns would have been much worse without its top performers. For instance, without its top 10% performers, the annualized returns shrink to 3.9%. It gets even worse without the top 25% performers. The returns drop to 0.4%. S&P 500 does pick winners in a very long term due to how it chooses strong stocks and gets rid of losers. So the conclusion is this: if you do not hold top performers, it's close to impossible to beat S&P 500. On another note, holding anything other than ETFs investing in broad stock market index will result in narrow bets. For instance, take Vanguard Semiconductor ETF or SMH. If you invest in it, it's like you are betting on outperformance of semiconductor or technology stocks. And true, over the last 10 or 15 years, Vanguard Semiconductor ETF beat S&P 500. But will it happen in the future? Will it persist, this outperformance? Who knows? It may very well do so, but maybe not. So for this reason, the S&P 500 or total stock market index ETFs, such as VTI, should be the core holdings of any portfolio, with other bets, such as, for instance, SMH, as a spice added here and there. The other reason why beating S&P 500 is hard is because many people are trying to time markets. But there are several reasons why timing markets rarely works, especially compared to the buy and hold approach. First, timing markets will require you to be in and out of stocks, and this will generate taxes, but it will also prevent you from compounding returns. And second, just timing markets is generally very difficult. Yes, you can use the most sophisticated technical indicators, but still it will be a crapshoot at best. According to Craftsman Research, the S&P 500 up days versus down days are about 54% versus 46% split over a very long term. But the big move days are very rare. For instance, over the last 5 years, the up days with 1% price gain or more represented 17% of all trading days, according to my calculations. The up days with 2% or more gain were 3.7% of all trading days. As for the 3+% or even 4+% moves, they happen very seldom, at about 1.3% and 0.7% incident rate. If you missed these days, your annual performance would have been much worse. Thus, the odds are against market timers. Of course, when people talk about stock picking, all eyes turn to Warren Buffett. But even Buffett himself said, the weeds wither away in significance as the flowers bloom. Over time, it takes just a few winners to work wonders. He also added, our satisfactory results have been the product of about a dozen truly good decisions. That would be about one every 5 years, and a sometimes forgotten advantage that favors long-term investors such as Berkshire. So even Buffett acknowledges that stock picking is very difficult and it takes a few outstanding stocks to beat S&P 500. Everyone talks about stellar performance for Berkshire Hathaway, but anyone barely mentions its failures. But the company had many failures that it barely escaped, or they dented its performance for years. People often ask Warren Buffett for investment advice. Here's what he had to say. Consistently buy an S&P 500 low-cost index fund. I think it's the thing that makes the most sense practically all of the time. But what if you still want to invest in individual stocks? After all, owning them can be a fun and rewarding activity for investors who have time to do research. For this reason, educating yourself and constantly learning about markets is a must. Moreover, it is best to invest money in individual stocks that you don't need and can afford to lose. If you're looking to learn about picking stocks, I included my top books in the description down below. Some of them are very technical and some of them are not, but they help me a lot to grow as an individual investor. That is it for this video. I hope you learned something actionable and insightful today. If you did, please give this video a like and subscribe to my channel for more content on investing. Thanks for watching.